If you're like most people, nobody really taught you how to invest. You were told to save money, maybe open a bank account, maybe get a 401k at work. So a lot of people do the same thing. They work hard, keep extra cash in a checking or savings account earning close to nothing, and say, I'll start investing when I have more. Meanwhile, prices quietly rise every year, and the people who own stocks and real estate quietly pull further ahead. In the United States, prices have gone up around 3 to 4% per year on average over the last few decades. If your money is sitting in cash earning 1% or less, you're actually getting poorer over time. On the other hand, the US stock market has historically returned around 9 to 10% per year before inflation, and about 6 to 7% after inflation for people who stayed invested long-term in broad index funds. So in this video, I'm going to give you a simple beginner's guide to investing. We'll cover why investing matters, how it works, which accounts to use, what to buy, and how to handle risk. By the end, you'll know exactly what your next step should be. Why invest at all? Reason number one is inflation. Over time, the cost of almost everything goes up. If prices rise 3% per year and your money earns zero, in about 20 years, your cash loses almost half its buying power. Reason number two is that our system rewards owners. In 2025, roughly 6 out of 10 American adults own stocks in some form, usually through retirement accounts or broad index funds. The stock market has survived wars, crashes, inflation spikes, and still hit new highs. People who simply bought broad funds and held on have quietly built serious wealth. People who never invested are still trading hours for dollars and wondering why they can't catch up. Reason number three is time. The earlier you start, the more your money can compound. Investing is less about being a genius and more about letting time and consistency do the heavy lifting. At its core, investing is simple. You either lend your money out or you own a piece of something. When you buy a stock, you own a tiny slice of a company. If that company grows and becomes more valuable, your slice becomes more valuable too. You make money in two main ways. The price goes up, and you sell for more than you paid, or the company pays you dividends, a share of its profits. Most beginners do not need to pick individual stocks. Instead, they can buy funds, baskets that hold hundreds or even thousands of companies at once. The most popular version is an index fund or ETF that tracks something like the S&P 500, which holds around 500 of the largest US companies, or a total US stock market fund that owns almost every publicly traded company in America. Historically, broad US stock index funds have returned around 9 to 10% per year before inflation, and about 6 to 7% after inflation over long periods. To see why time matters so much, imagine this. You invest $250 a month into a simple index fund that earns 8% per year on average. If you do that from age 25 to age 67, about 42 years, you end up with a little over $1 million. You've put in about $126,000 of your own money. The rest is growth. That's the power of compound interest. Your money earns money, and then that money earns more money. Before you throw money into the market, you need a stable foundation. Step 1. Deal with high-interest debt. If you're paying 20% on credit cards, there's no point chasing 8% in the market. Focus on paying off toxic debt first, especially anything in the mid-teens or higher. Step 2. Build an emergency fund. Aim for at least 3 months of essential expenses in a high-yield savings account. If your income is unstable or you have kids, lean closer to 6 months. This isn't about earning a high return. It's about having a buffer so you don't have to sell investments at the worst possible time. Step 3. Know your time horizon. Money you need in the next 1 to 3 years should generally not be in stocks. Investing is for long-term goals, retirement, financial freedom, or big life milestones at least 5 to 10 years away. Once your high-interest debt is under control and you've got an emergency fund, you're ready to become an investor. In the United States, the main question isn't just what do I buy, but also which account do I use? If you have access to a 401k or a 403b at work, that's often step 1. Many employers offer a match. For example, they might match 3% or 4% of your salary if you contribute the same. That's an instant 100% return on your contribution before the money even hits the market. At a minimum, try to contribute enough to get the full match if you can. Next, look at IRAs, individual retirement accounts you can open yourself. A traditional IRA may give you a tax deduction now, and you pay taxes later when you withdraw in retirement. A Roth IRA gives you no deduction up front, but your money grows tax-free, and qualified withdrawals in retirement are also tax-free. If you have a high deductible health plan, you might also have access to an HSA, a health savings account. In the United States, HSAs are sometimes called triple tax advantaged because you can get a tax deduction going in, the money grows tax-free, and qualified medical withdrawals are tax-free too. After you're using your tax-advantaged options, or if you've maxed them out, you can also invest through a regular taxable brokerage account. There's no special tax break, but there are no contribution limits, and you can access the money whenever you want. Now the big question, what should a beginner actually buy? You don't need a complicated portfolio with dozens of funds. For most beginners, a 2 or 3 fund strategy is more than enough. Example 1 is a simple S&P 500 index fund. This gives you exposure to hundreds of the largest U.S. companies in a single investment. Example 2 is a total U.S. stock market fund. Instead of just the biggest companies, it holds large, mid, and small cap stocks across the entire American market. If you want even more diversification, you can add a total international stock fund, so you own companies from around the world too. As you get older or closer to your goal, you can add bonds through a U.S. bond index fund. Bonds usually move differently than stocks and can help reduce the ups and downs in your portfolio, especially as you approach retirement. The secret isn't picking the perfect fund. It's choosing low-cost, diversified index funds, sticking with a simple plan, and letting time and consistency work for you. Let's put this together into a simple plan. Step 1. Choose a platform. That might be your employer's 401k provider, or a well-known brokerage where you can open an IRA or a taxable account. Look for no account fees, no trading commissions on ETFs, and access to low-cost index funds. Step 2. Decide your monthly amount. It doesn't have to be huge. If all you can do is $50, start with $50. If you can comfortably do 10 to 20% of your take-home pay toward investing and retirement, even better. Step 3. Automate it. Set up automatic transfers so money moves from your checking account into your investing account every month and then into your chosen fund or ETF. This is called dollar cost averaging. You buy a little bit whether the market is up or down. Step 4. Keep fees low. Prefer index funds and ETFs with expense ratios well under 0.20% if possible. Over decades, paying 1% instead of 0.05% can cost you tens of thousands of dollars in lost growth. Step 5. Understand risk and selling. In the short term, prices can swing a lot. Over longer periods, broad, diversified stock funds have historically recovered from crashes and gone on to reach new highs. For most long-term investors, the main reasons to sell are rebalancing, making a thoughtful change to your plan, or finally using the money for what you invested for, like retirement. Let's talk about the question everyone has but rarely asks out loud. Is investing risky? The honest answer is yes. But doing nothing is risky too. In the short term, the stock market can drop 10, 20, even 30% or more. That's normal. If you look at any chart of US stocks, it's a series of bumps and crashes on the way up. There are no guarantees about what happens in any single year. But here's the key. Over longer periods, broad, diversified stock funds have historically recovered from every crash and gone on to reach new highs. The people who got hurt the most weren't the ones who stayed invested. It was the ones who panicked, sold low, and never got back in. The way you manage risk isn't by trying to predict every move. It's by using money you don't need for the next few years, diversifying across many companies and funds, keeping your costs low, and sticking with your plan through the ups and downs. Short-term volatility is the price of admission for long-term growth. You can't get the return without feeling a little bit uncomfortable sometimes. So here's your beginner blueprint for 2025. Fix your foundation by paying off high-interest debt and building an emergency fund. Use the right U.S. accounts like 401ks, IRAs, and HSAs. Buy simple, low-cost index funds instead of chasing hot tips. Automate your contributions and stay invested through the noise. You don't have to become an expert. You don't have to pick the next Tesla or time the next crash. You just need a simple system that you actually follow. Do one thing after this video. Decide the exact dollar amount you're going to invest every month, even if it's tiny, and write it down. Then tell me in the comments what your first investing goal is. Is it your first $1,000 invested, your first $10,000, or your first $100,000? If you want more step-by-step videos on money, psychology, and building real freedom, make sure you like this video and subscribe so you don't miss what's coming next. This is Minecraft, where ideas become action and action becomes your future.